Dawn slid over Lower Manhattan like a tired stagehand. Traders in boxy suits spilled from cabs. Coffee steamed under cold October air. The tape from Friday still burned red in their eyes, and somewhere in the Midwest, machines were already warming up, waiting for a signal. Since 1980 the market had climbed like a rocket. Reagan tax cuts, disinflation, and computers made money feel frictionless. Index funds grew, futures and options stitched new highways between Chicago and New York. Avant century bull grafted onto 19th century plumbing. Beneath the optimism lived a new promise with an old name: insurance, portfolio insurance. A math-driven way to cap losses without buying puts. You didn't insure with a contract. You insured with motion. Sell a little when prices dip. Sell more when they fall. Sell the most when they crash. The architects were brilliant: Hayne Leland, Mark Rubinstein, John O'Brien. Their insight elegant and dangerous, synthetically replicate a put by trading the futures. In continuous markets you'll glide along the curve. In discontinuous markets you'll fly off the edge. Pension funds bought the pitch because it solved two fears at once: downside risk for retirees and the career risk for managers who could say, "We're hedged." By 1987 hundreds of billions were wired to rules that would sell into weakness, a fire drill rehearsed on paper, waiting for the alarm. Program, trading joined the cast with a different beat, computers hunting tiny gaps between futures and cash. Buy the cheap side, sell the rich side, capture the basis in seconds. Arbitrage smoothing markets until it didn't on October 14th. Rates twitched higher, the dollar wobbled, Germany tightened, Treasury officials muttered about currencies, deficits, pride. Friday, the 16th, was options expiration. Volatility sizzled like oil in a pan. The Dow fell more than 4%, and the weekend felt too short for fear. Half a world away, Asia opened before New York could sleep. Selling rolled from Hong Kong to London like weather across an ocean. Chicago's traders woke to a market already leaning over a cliff, and the machines that promised safety waited for their first instruction. Monday, October 19th, 1987. S&P futures gapped lower on the CME, bids thin, voices raw, algorithms began their duty. Sell more futures as the price falls. What looked like discipline on the whiteboard turned into fuel on the floor. In New York, the specialist system strained. Fonjamed, Coil, Sakon, futures screamed one story. Cash, stocks whispered another. The bridge between them, index arbitrage, snapped under the weight. As the futures fell below fair value, arbitrageurs should have bought futures, sold stocks, but you can't sell stocks that aren't open. You can't hedge what won't print. Chicago's order books kept filling. New York's doors stuck shut, and the basis that kept markets married became a divorce. Portfolio insurance kept selling because the rule said sell. Programs saw prices drop and pushed harder. The market fed on its own motion. A serpent chasing its tail, liquidity, once a lake, shrank into a puddle. By midday, specialists stood knee-deep in imbalance. Buy orders vanished. Sell orders piled like sand against a door. Market orders from mutual funds and pensions arrived late, then all at once. The people who trusted the machines discovered the machines trusted people. In options pits the implied volume spiked like a siren. Quotes widened so far they stopped being quotes. Market makers stepped back. Survival first. Risk moved from screens to throats. Phones across America rang in a new register. State pension trustees, university endowments, corporate treasurers, each one asking the same question through a different voice. Is this covered? Are we protected? What does the insurance do now? The answer was simple and terrible. It sells. It sells more. It sells hardest, because your protection is to run faster than the fire, and everyone bought the same shoes. The tape recorded numbers that no pencil had rehearsed. General Electric down double digits, IBM spinning, Exxon slipping on its own oil. Some stocks didn't trade for hours. When they did, it was a jump cut. Prices leaped between scenes. No continuity, just damage. At 3 p.m., the idea of price became a rumor. Quotes were placeholder art. Trades printed like hail. The Dow slid into a 508-point hole, minus 22.6%. The S&P fell more than 20, an empire of paper, leaning hard with the wind. When the closing bell finally dragged the day to an end, silence arrived like a stranger in a bar that had been shouting all night. Traders stared at each other, each one counting the distance between fear and blame. Outside, the city kept moving, confused that money could be so loud and yet invisible. Here is the anatomy under the bruise. Portfolio insurance created negative convexity. Sell low to insure lower. Program trading made the bridge between futures and cash faster and stronger. Then discovered bridges carry fire too. Microstructure mattered like never before. The NYSE specialist model promised continuity but owned limited capital. The CME pit promised speed but not sympathy, and no one owned the space between them until it mattered. Would a real put have saved the day, perhaps for the buyer, but not the market? Because real puts find sellers before the fall, synthetic puts must sell during the fall to exist at all. On Tuesday, the rebound jolted like a heart, restarting. Greenspan's Federal Reserve issued a sentence that still echoes. The Fed stands ready to serve as a source of liquidity to support the economic and financial system. A promise soft as velvet, heavy as steel. Brokers lined up overnight capital, banks inhaled, specialists reappeared as prices rose, the futures basis healed. Fear downgraded to caution, caution to calculation. The tape found a voice that sounded like numbers again. The hunt for a single villain, a smoking gun, never mattered less. Trade deficits, interest rates, currency fights. Taxes, valuation, all were embers. Portfolio insurance was the wind. Together they found dry grass and a city with wooden streets. The crash didn't trigger a deep recession. Real economy indicators stumbled, then found their footing. But the market's memory changed shape. Risk was no longer what you owned. It was how fast your neighbors could sell. Regulators built new furniture so crowds couldn't run through the same door. Circuit breakers for indexes, collars for futures. Coordinated market-wide halts. NYSE and CME agreed to pause together when pain reached thresholds. No more free falls without a breath. Capacity became a policy, not a hope. Order routing was upgraded. Superdot expanded. Openings and imbalances published. Cross-market councils began watching the seams where systems touch. A quiet committee people nicknamed the Plunge Protection Team took notes in the dark. For Leland, O'Brien, and Rubenstein, the lesson had edges. Their idea worked in the lab of continuity, in the field of panic. Gaps replaced glide. You cannot hedge with a plan that assumes the bridge exists when the bridge is burning. A generation of quants learned new words the hard way: gamma, convexity, liquidity, basis risk. VAR was born in the 1990s. Stress tests gained a seat at the table. Models began to ask not what happens most days, but what hurts on the worst day. Technology kept marching even as knees remembered the bruise. Electronic trading replaced 1,000 shouts with 1,000,000 packets. ETFs built an index in a box and put red and green buttons on the side, and the line between hedge and amplifier blurred like heat over asphalt. Black Monday became a parable managers quoted in footnotes. Remember that hedges can become herd, that speed can become force, that liquidity is a crowd, not a property, and that the worst price in the world is the one you must accept when you must sell. We like to say markets are rational, but markets are mirrors, and panic fogs glass. On days like this, the human urge to run is the dominant factor of production. Machines only make that urge instantaneous. The question is not whether portfolio insurance was evil. It is whether good intentions can become bad physics when synchronized. The more a strategy depends on selling into falling prices, the more it requires someone braver and richer on the other side. Think of rain on a hillside. One drop is nothing. 100 find paths. 1,000,000 find each other. Pretty soon the hillside is a river with a plan of its own. Black Monday was rainfall. Portfolio insurance was gravity. Now step back to the living room, the pension plan, the college fund. What does this old bruise tell a young saver about the bones underneath? Diversification across storylines, not just tickers, matters most when crowds agree. Cash is a position, not a sin, and hedges you can carry through gaps are the only hedges that count. Watch the seams, not the headlines, the future's cash basis, the depth of the book, the cost of optionality. Dealer gamma and volatility term structure, the plumbing under the wallpaper. Because cracks appear, they're long before they appear on the news. When markets melt, the loudest voices predict a new world. But the world we got after 1987 was the old one with guardrails. We did not abolish momentum, we slowed its stampede. We did not outlaw fear, we gave it a time out. Yet guardrails bend, code forgé, engineers retire. The 2010 flash crash wrote a footnote in the same hand. Liquidity vanished in minutes. ETFs traded like riddles. Once again, the fix became part of the problem. Then the problem became the fix. The reflex of our era is to demand a switch. Turn it off, turn it on, freeze, unfreeze. Markets are not refrigerators, they are weather. You can seed clouds and draw charts, but you still pack an umbrella. Black Monday is not an antique, it is a lens. It shows how a single innovation can change behavior, how hedges can turn to herds, how models assume bridges that panic removes, how a sentence from a central bank can steady a crowd like a lighthouse. We should honor the brilliance that built portfolio insurance. And we should remember its blind spots. Markets do not offer continuity as a right. Continuity must be earned by design and paid for in capital. For the individual, the best insurance remains boring. A cash buffer measured in months, not days, a glide path you can hold when screens go red, and a humility that says, I might be the herd and not know it. For institutions, rehearsal must include the missing bridge, assume gaps, assume collateral calls, assume phones that do not answer. Assume you cannot sell the thing you planned to sell, then ask whether the plan survives as a story you can tell your board. For regulators, the goal is not to ban speed. The goal is to keep speed from becoming force, Align halts across venues, publish imbalances, map the seams. Design for the day when humans step back and machines talk to machines. When you walk past the Bronze Bull downtown, remember, it was installed after the crash, not before. Hope is a statue, discipline is a policy, and memory is the commodity most easily debased. On the morning after Black Monday, a young trader told a reporter, "I didn't know the market could do that, but now I do. Learning is expensive in our business." He said, "Ignorance is more expensive still." This is the work of financial history, not to predict the next storm, but to read the clouds we've already seen. To teach our hands where the guardrails live, so that when the wind returns, we know which bridge is real. The Dow has printed 1,000 fresh records since that day. Cities have changed. Screens got thinner. Spreads got smarter, but gravity has not retired, and crowds still run. The best we can do is remember how it felt to stand in that rain. Black Monday, 1987, was the day an insurance policy became a spark. The day a hedge learned it was a herd. The day speed discovered force and the bridge discovered fire. The market survived. The lesson should too. Carry it with you the next time the tape bends like light around a star. Think about where the bids live, who must sell, who can wait. Ask whether your insurance works when the bridge is out, and whether your plan honors the gap, not the glide. A market is a promise written in pencil. A crash is an eraser in a hurry. Our job is not to stop the eraser. Our job is to keep rewriting the promise better and thicker. If this story gave you a new way to see history, subscribe.